In this video, we're going to be talking about what is inflation and how does it impact markets as well as central bank decisions. How economists are forecasting UK interest rates could rise to 6.25% by the end of 2023. The key changes to UK interest rates since 2021. The economic outlook driving UK interest rates. And when the Bank of England expects UK inflation to fall. So what is inflation and why is it important? Inflation is the rate at which prices rise and fall over a period of time. For example, if prices rise by 2.5% over the last year, annual inflation will be deemed to be 2.5%. Typically, inflation is a weighted measure of a basket of goods and services, with some having a larger influence over the total inflation rate than others. In the UK, inflation is tracked by the UK Office for National Statistics, or ONS. Tracking inflation data is very important as it's a key indicator of economic health and price stability. This is why many global central banks, such as the BOE, the Bank of England, have an inflation target within their mandate. But how did inflation become a problem? The UK interest rates have been rising rapidly since December 2021, having hit record lows in August 2020, when the Bank of England last reduced base rate from 0.25% to 0.1% in response to the COVID pandemic. Since then, rising inflation has dramatically changed the BOE's interest rate stance, with the UK's Monetary Policy Committee, or MPC, which decides UK interest rates, voting to increase the UK's base interest rate multiple times in an effort to curtail rising inflation, which is seen as a significant threat to the UK economy. But why is the Bank of England raising interest rates? The Bank of England is increasing interest rates in an effort to cool demand-side effects to inflation. Higher interest rates increase the cost of borrowing and debt, meaning consumers have less of an incentive to borrow money for credit cards, loans, and mortgages. Higher interest rates also mean you earn more money for your bank deposits and bonds, so it incentivizes you to keep money at the bank and not spend it. Therefore, higher interest rates are an attempt to cool prices by weakening demand. How have interest rate expectations changed though? There's been a dramatic change in the market view on UK interest rates in the last 2 months. At the start of the year, we had expected UK interest rates to reach around 4.5% by the end of 2023. Today, we now expect the UK interest rates could rise up to 6.25 or even 6.5% before the end of the year, which marks a substantial material change. The Bank of England's Plan A was to consistently increase UK interest rates. That plan has failed, with inflation remaining stubbornly high, despite dramatic falls in wholesale energy prices. So what's Plan B? Plan B for the BOE is to aggressively raise rates more than the market had initially expected. Simply put, UK inflation has remained far more stubborn than initially expected. Core inflation, which strips out energy, rose to 7.1% in May, which was a shock. But what about impact on mortgages? In short, it's not looking good. We know there are around 400,000 fixed mortgage deals set to expire in the next few months, and those mortgage holders will inevitably be switching to deals at far higher rates than they are used to. We've already started to see hundreds of mortgages pulled from the marketplace due to credit institutions not wanting to take on extra risks given the clouded performance of the UK's economy and volatile debt markets. The average 2-year fixed mortgage rate is now exceeding 6%, and with every rise in UK interest rates, those rates are expected to go on even higher. We could be seeing an average 2-year mortgage deal rise to 6.5% sooner than later. So, how has inflation affected you? Let us know in the comments. Thank you for watching. If you enjoyed this video, drop us a like and subscribe to the channel for all your investment and trading news.